Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finance. And let me tell you, Cinemark Holdings Incorporated is serving up a financial report that's got more twists and turns than a surprise blockbuster plot. So we're diving deep into their latest quarterly report, a document that tells us how the movie theater giant is doing right now. Think of it as a peek behind the popcorn curtain to see if the numbers are as thrilling as the movies they show. Make sure you are subscribed to Corporate Decoder because we bring you these insights week after week. And hey, if you want to chat more about these filings or anything corporate, join our Discord community. The link is in the description below. Alright, looking at Cinemark Holdings Incorporated's balance sheet, we see their total assets stood at roughly $4.4 billion as of the 30th of September 2025. Now, that is a big number, but here is the kicker. Just a few months earlier, at the end of December 2024, their total assets were closer to $5 billion. So that is a noticeable drop. Digging into the liabilities, their total current liabilities stood at about $898 million at the end of September 2025, which is down from nearly $1.3 billion at the end of 2024. That looks like they've managed to pay off some short-term debts, which is generally a good sign. But then we see this liability for warrants showing up $132.6 million. This just appeared in 2025. Warrants are basically options to buy stock in the future, and when they're recorded as a liability, it means the company owes something related to these warrants. Well, unpack what this means later, but it is definitely a new piece of the puzzle. Now, let's talk about the revenue. Over the first 9 months of 2025, Cinemark brought in about $2.3 billion. That is up from roughly $2.2 billion in the same period back in 2024. So revenue is growing, which is the first sign of a healthy business. Admissions revenue, the tickets people buy, brought in about $1.16 billion for the 9 months ending the 30th of September 2025. That is up from about $1.11 billion in 2024. More people are buying tickets, which is great news for movie theaters. And here is where the real profit often is concession revenue. For the same 9-month period in 2025, they raked in about $924 million, up from $884 million in 2024. People are definitely still buying popcorn and drinks along with their movie tickets. But all that revenue comes with costs. Total cost of operations was about $2.07 billion for the first 9 months of 2025. That is up from about $1.97 billion in 2024. Their costs are going up too, which makes sense since they're selling more. So after all those sales and all those costs, what is left before other expenses operating income? For the first 9 months of 2025, it was about $268 million. That is slightly up from $264 million in 2024. It is not a huge jump, but it is positive growth. Now we get to some of the more interesting and frankly concerning parts of this report. Remember that warrant liability we saw earlier? Well, here it is again. Loss on warrants a whopping $54.5 million in just 3 months in 2025. This seems to be a major expense directly linked to those warrants we saw on the balance sheet. They're reporting a $54.5 million loss related to these warrants. Interest expense is also a big factor. For holdings, it was about $110 million over 9 months in 2025. For Kusa Incorporated, it was around $95 million. These are significant amounts of money just to service their debt. And after all the revenues, expenses, interest, and taxes, what is the actual profit for the company's owners? For the 9 months ending the 30th of September, 2025, net income attributable to Cinemark Holdings Incorporated's common stockholders was about $104 million. That is a big drop from the $258 million they made in the same period in 2024. This massive decrease, driven by that warrant loss and other factors, is the biggest takeaway here. Looking at their assets, theater properties and equipment net was about $1.12 billion, down slightly from about $1.14 billion. And then there is goodwill, which is basically the value of their brand and reputation beyond their physical assets, sitting at a hefty $1.24 billion. This figure has actually increased a bit, which might suggest acquisitions or upward revaluations, but goodwill is also one of the first things to be written down if their business falters. On the equity side, we see accumulated other comprehensive loss. That is a fancy term for unrealized losses that haven't hit the income statement yet. For holdings, it is a loss of about $393 million. They also disclose how they value certain assets and liabilities. Notice fair value inputs level 3. This means they're using internal models and assumptions for valuation, as direct market prices aren't readily available. This can indicate where estimates, rather than concrete market data, are playing a bigger role in their financial picture. Let's talk about how Cinemark is investing in its future. For the first 9 months of 2025, total capital expenditures were about $105 million. That is higher than the $90 million they spent in the same period in 2024, showing they're putting more money into building and upgrading their theaters. They operate a massive network with roughly 5,644 screens worldwide as of the 30th of September 2025. Interestingly, the number of screens has stayed pretty stable year. Over year, they opened one new theater in the US but closed one, and internationally they seem to have closed a few screens as well. Maybe as part of optimizing their operations. Now here is something that always catches my eye in these reports inside of trading plans. We see that Melissa Thomas, the chief financial officer, adopted a plan to sell up to 100,206 shares of company stock. Valmir Fernandes, president of Cinemark International, had a plan to sell up to 50,000 shares, which has since expired. Michael Cavalier, the general counsel, is also selling shares under a plan. Wanda Gearhart, the chief marketing officer, has a plan to sell over 63,000 shares, and Sean Gamble, the CEO, has adopted a plan to sell over 180,000 shares. While these plans are often for personal financial planning, a significant amount of insider selling can sometimes signal that executives don't see immediate upside in the stock. The report also details ongoing legal battles. Cinemark is facing a class action lawsuit alleging violations of the Fair and Accurate Credit Transactions Act, and another one concerning the alleged mislabeling of beer cups. They also mention a lengthy battle with National Cinemedia Incorporated over an exhibitor services agreement, which Cinemark ultimately lost on appeal. These legal entanglements can be costly and distracting, so it is worth keeping an eye on how they play out. Now for some good news on the tax front, a new law called the One Big Beautiful Bill Act, or OBBA for short, was passed in July 2025. This law makes some tax breaks permanent, which Cinemark expects will help them deduct more expenses and reduce their cash taxes. In fact, due to this, they released around $47.7 million in previously held back tax reserves, boosting their financials for this period. And looking ahead, things are moving fast. On the 30th of October 2025, the board approved a new share repurchase program worth $300 million. Then on the 4th of November 2025, they announced an increase in their quarterly dividend from 32 cents per S-share to 36 cents per share. This suggests management is feeling confident about the company's future financial health and wants to reward shareholders. So, what is the story here? Cinemark Holdings Incorporated is navigating a complex financial landscape. They're seeing revenue growth, particularly in concessions, showing that moviegoers are still enjoying the full theater experience. They're also investing more in their properties, which is crucial for staying competitive. However, the massive loss recorded on warrants in 2025, the significant drop in net income compared to the previous year, and quite a bit of insider selling are definite red flags that investors need to pay attention to. While the tax law changes and the dividend increase are positive signals, the market is always watching how they manage their debt and those tricky warrant liabilities. It is a balancing act between growth and managing financial complexities, and for Cinemark, it looks like they're in the middle of a very dramatic act right now. Alright? That is our breakdown of Cinemark Holdings Incorporated's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. And don't forget to check out the Discord in the description if you want to keep the conversation going. Thanks for watching. See you next time.